Beginning of 2024, a business owner walks into my office making about $4 million a year in net income. He sits down and tells me he has two priorities. One, he'd been audited before, didn't want to go through that again, wanted to be audit proof. Two, he said, I know where this tax money is going and I don't want to pay a single dollar more than I legally have to. Ideally under 15%. Most CPAs hear that and go one of two directions. Either it's no way, can't do it, and they shut the conversation down before it even starts. Or they start making stuff up, thinking about what offshore structure they can farm out to buy their way into a new client. We didn't do either. We built a system. That system got him to 12.5% effective tax rate, zero penalties, zero stress from the IRS, zero stress from California. And if you know California, you know that's saying something. I'm Anthony Price, CPA. I work with high-income business owners and investors. Most CPAs in my industry fall into one of two camps. Either they play it safe on everything and you overpay every year, or they're the guy on social telling you to write off your Lamborghini, which is how you end up audited. I'm neither. I'm open to aggressive positions, but only when we can document them well enough to be audit defensible. When the IRS shows up, we have the paperwork. You don't get hurt, you don't go to jail. Here's what most people get wrong about tax planning at this level. They think getting to 12.5% is about finding one clever tax strategy. It's not. It's about building a system where you can't skip ahead. Skip the foundation and no amount of cost segregation or bonus depreciation will save you. Here's the exact 3-layer system we used. Layer 1, master the basics. Layer 2, intermediate strategies. And layer 3, strategic investments. Each one builds on the one below it. Let's go. First up, entity structure. One decision, that's all it takes. One structural decision can mean millions in total tax difference over the course of a career. And most people get it wrong. Or worse, they never revisit it after they set it up on LegalZoom when they were making 60 grand a year. Now this particular client is a serial entrepreneur. He's got multiple businesses, so here's how we structured it. Each unique business operates as either a partnership or a single member LLC. Every one of those is owned by his S-corporation. The S-corp sits at the top as the operating entity. It's the hub. Then, separately, his investments sit in a different single member LLC owned by his trust. Not his S-corp, his trust. That's intentional. You want clean separation between operating income and investment income. Different tax treatment, different asset protection profiles, different planning opportunities. Here's the design principle most people miss. Keep filings in compliance as simple as possible. It's obvious. Every partnership, S-corp or C-corp you add is another tax return, another set of books, another thing to maintain. Now, single member LLCs are usually not additional tax returns. They're disregarded entities, which is part of why we use them in this structure. But don't create complexity for the sake of looking sophisticated. Create structure that serves a purpose. Now, this client has multiple businesses, so the structure is justified. If you're running one business making 400 grand, you probably don't need 4 LLCs and a holding company. You need an S-corp and good accounting. Keep it clean. Now, the entity structure is important, but if you don't couple it with this next piece, you're setting yourself up for an audit letter you can't answer. Accounting. This is where it actually pays off. I know that sounds boring. Nobody makes viral content about bookkeeping, but this is how you become audit proof. Period. Every receipt, every invoice, full documentation. I'm not talking about shoving receipts in a folder once a year. I'm talking about a system where every transaction is categorized, documented, and reconciled weekly. Let me tell you what that looks like in practice. California sent this client audit letters twice. The IRS sent one. 3 audit letters in total. You know what happened each time? We replied within a week. Organized documentation, clear response, case closed every single time. No negotiations, no back and forth, no hiring a tax attorney, just here's the documentation you asked for, have a nice day. And that doesn't happen by accident. That happens because the books are clean before the letter ever arrives. Here's another story. This client was in talks to sell one of his businesses. The buyer needed the full financial package, P&L, balance sheet, cash flow statements, all the supporting documentation. Most businesses, the process takes weeks, sometimes months. I've seen deals fall apart because the seller couldn't produce clean financials. This client had the entire package over to the buyer within a day. They had a letter of intent within a week. Now he ended up passing on the sale, decided to let the business cash flow instead. But the point is, he had the option. He could move fast because his books were pristine. I've seen messy books blow up multi-million-dollar deals. I'm not exaggerating. The buyer's due diligence team finds inconsistencies, unexplained transactions, missing documentation, and suddenly the 8-figure offer turns into a lowball or a walkaway. Detailed accounting is not a luxury. It's a necessity. If you take nothing else from this video, take that. Clean books are the core. And this is where most people still drop the ball. The compliance calendar. Here's what ours looks like. Books are closed monthly. Transactions categorized weekly. Payroll returns are filed quarterly. Financial projections done twice a year. Tax planning kicks off in May. Not December, not October, May. Returns are extended and filed in August. The result? 0 penalties. Ever. Not one. In the entire time we work with this client. We have a comprehensive checklist with the entire year mapped out. Every deadline, every deliverable, every filing, it's all on the calendar before the year even starts. You follow the system, nothing gets missed. This is what separates reactive CPAs from proactive ones. Reactive CPAs are scrambling in March trying to figure out what you owe. Proactive CPAs already have a plan in May and are executing against it for the rest of the year. Now that's layer one. Entity structure, professional accounting, compliance calendar. It's not sexy, but it's the foundation everything else is built on. Layer two, this is where we start actually saving money. Let's talk about QBID, the Qualified Business Income Deduction. This is a free 6-figure deduction that most high-income business owners either don't know about or aren't maximizing. And I say free because it requires zero additional investment. It's just math. It's just running the numbers right. Here's how it works at high income levels. Your QBID is the lesser of 20% of your qualified business income or 50% of your W-2 wages, or 25% of your W-2 wages and 2.5% of unadjusted basis of assets. We're gonna skip that and just look at 20% of your qualified business income or 50% of your W-2 wages. Those are the two limits inside section 199A. On $3.5 million in net income, the 2/7 rule, that's just how the math shakes out when you're trying to max the W-2 limit. Put your optimal owner payroll at around $1 million. At $1 million in W-2, 50% is $500,000 of a qualified business income deduction. Now, 20% of $3.5 million minus $1 million salary, you have $2.5 million net income. That's also $500,000. Simple enough, right? But here's what most CPAs miss. QBID is also capped at 20% of your total taxable income. That's a different number. So if this client has other losses, maybe from strategic investments, which we'll get to, that brings the taxable income down to, say, $500,000. Then his QBID cap is $100,000. 25% of $500K is $100,000. At that point, to max the deduction at $100,000, you only need $200,000 in W-2 wages. Not $1 million, $200,000. So instead of paying payroll taxes on $1 million salary, you're paying payroll taxes on $200,000. That one adjustment, understanding how section 199A interacts with other losses on the return, saves tens of thousands of dollars every year. This is why your CPA can't just run your numbers in a vacuum. They need to see the full picture. Every entity, every loss, every deduction, all at once. That's where the savings live. Now, before you start thinking layer two is only about QBID, you need to consider this next piece, retirement accounts. This client puts $70,000 a year into a solo 401k with a backdoor Roth conversion. Here's what's interesting. At his income level, he saves enough through other strategies that he actually skips the upfront tax deduction entirely. He doesn't need it. Instead, he's playing the long game. Let's do the math. 10 years of contributions at $70,000 a year. 20 years of growth after that. At a 7 to 8% return, you're looking at roughly $7.5 million in a completely tax-free Roth account. On a multi-million-dollar income, 70 grand a year barely even registers. It's a rounding error on his lifestyle, but let that compound for 20, 30 years and it becomes generational wealth that never gets taxed again. And here's the bonus most people don't think about. Asset protection. Retirement accounts are generally protected from lawsuits and creditors. If you're a business owner with any kind of liability exposure, that matters a lot. So that's layer two, QBID plus retirement accounts. No risk, no complicated structures, just knowing the rules better than the next guy and actually running the play. Quick aside, if what I just walked through made you realize you're leaving $50,000, $100,000 on the table every year because your CPA isn't seeing the full picture, that's literally what we do at Priceless CPA. We quarterback your entities, your returns, and your investments. Someone actually coordinates the whole thing. Links in the description to book a strategy call. Layer three, strategic investments. The question we ask every client at this stage is simple. What business or asset class is aligned with your interests and skills that also creates massive paper losses? For this client, the answer was a trading business. He invested into it and then took an active role managing it. That's the key detail. He didn't write a check to some fund and sit back. He became an operator. That matters for the tax treatment, and I'll come back to why in a second. The mechanic is losses plus accelerated depreciation. And here's the part most people miss. You want to front load losses that don't track your actual cash outflows. Under 168K, bonus depreciation, you're taking most of the deduction in year one, not spreading it over 5, 7, or 15 years. Follow the math. If you put 100 grand into an asset and that asset generates 400 grand in paper losses, that's 4 times your cash. At a 37% federal rate, that's almost 150,000 in tax savings on a $100,000 investment. Your tax savings alone cover more than what you put in. You're in profit before the asset does anything at all. Now add the asset itself. If the business generates cash flow that offsets the deferred taxes you'll eventually owe on a recapture, you're essentially making money out of zero. That's insane ROI. You're profitable in year one on an investment that also compounds for decades after that. That's what the rich really do. Now here's why active management matters. When you're a material participant in the business, the losses are non-passive. That means they can offset your other active business income, not just other passive income. The one distinction is the difference between a loss that saves you hundreds of thousands and a loss that sits on a shelf doing nothing for your current year tax bill. Same mechanic works across asset classes. Real estate, oil and gas, equipment heavy businesses, aviation, different industries, different risk profiles. Same playbook. You're buying business assets, front-loading depreciation to save on taxes now, while owning something that actually grows in value. And I want to be transparent about this because a lot of people in my industry aren't. These are real investments with a real risk. You can lose money. Depreciation is a timing benefit. You get the deduction now, but if you sell the asset later, there's a recapture. The investment has to make sense on its own without the tax benefit. If the only reason to do something is a tax savings, it's probably not a good investment. What made this work for the client is that he actually understood the business. He wasn't blindly writing checks to some syndication he found on the internet. He was making informed decisions about an asset he could evaluate and operate. Even with that risk, doing this right makes a difference of millions, often tens of millions, over a career. Let me put it simply. When you stack the tax benefits on top of the economic upside, you can turn a 10% return into a 20% return. The tax benefits are that significant. And when you compound a 20% return instead of a 10% return over 15, 20 years, that's not a marginal difference. You're doubling how fast your wealth grows. That can literally be the difference between being worth 5 million or 10 million, 10 million or 20 million, 20 million or 40 million. All because we play the tax and investment game strategically instead of just writing a check to the IRS every year. That's the difference between strategic tax planning and reckless tax avoidance. So what does all of this add up to? Layer 1, entity structure, professional accounting, compliance calendar, the foundation that makes everything else possible and keeps the government off your back. Layer 2, QBID, retirement accounts, free money when you actually run Section 199A and Section 401k right. Layer 3, strategic investments that create accelerated depreciation and losses while building real economic value. The result for this client, a 12.5% effective tax rate on $4 million of net income. Zero penalties, zero audit stress, and a portfolio of assets growing in value while reducing his current tax burden. That's not one trick, that's a system. Here's what I tell you if you were sitting across from me right now. Every single thing I just described is legal. It's documented, it's defensible, there's no gray areas here. The difference between someone paying 37% and someone paying 12.5% at the same income level isn't that one person is cheating, it's that one person has a system and the other person doesn't. Most business owners at this income level are overpaying by 6 figures a year minimum because they don't have a framework. They've got a CPA who's filing returns, not one who's building a strategy, and that difference costs you thousands, millions every year. If that sounds like you, start with layer 1. Get your entity structure right, get your books clean, get your compliance calendar in place. You'd be amazed how many advanced strategies become available once the basics are handled. Now, if you want us to build this out for your situation, links in the description. And if you want to go deeper on layer 3, I'll break down exactly how the active participation test works and why most investors fail it. That video is next on your screen. Thanks for watching.